Ina mana, ina reo, na tangata no na hauwha, tēnā koutou katoa. Appropriately in that Māori greeting, it's welcoming people from all four winds, which I think this morning is rather true. So good morning, I'm Jane Bryson, I'm the Dean of the Wellington School of Business and Government, and it's a real pleasure to welcome you all here this morning to this XRB Victoria University of Wellington seminar on the future of financial reporting. And it's a very great honour to have as guest speaker this morning Dr. Andreas Barckow, Chair of the International Accounting Standards Board. I will have Carolyn introduce Andreas in a moment, but I just wanted to say that this is part of a series that started in May this year, where the Wellington School of Business and Government wants to stimulate discussions of accounting for the future. We believe accounting is important to the future of business and society. It's changing and is arguably becoming more important. So in May this year, we hosted a Dean Series seminar on accounting for the future with a stellar panel headed by April McKenzie from XRB, but also people from Audit New Zealand, from CANS, and people from within our own faculty. And they kicked off debate on challenges and changes that face accounting in the future, in particular the changing role of the accountant, change for organisations which have to measure and report on climate impacts of business and greenhouse gas emissions, adapt to and develop digital reporting and AI capacity, and potential future reporting requirements. So this morning we're really privileged to be able to continue that conversation looking at the future for financial reporting with an international speaker of the calibre of Andreas. I have to give you a few of the housekeeping instructions, which all the Kiwis in the room will be familiar with. Don't panic, Andreas, you've probably heard this in Wellington before. Just to remind people of the emergency procedures for this building. For fire, there will be an alarm. We leave the building using the nearest fire exit, which is the stairs, so we can exit out either set of doors, and the stairs are obvious. Just follow someone like me or another staff member. And we assemble in Bunny Street, which is between us and the law school. Earthquake, it's the usual instructions: drop, cover and hold until the shaking stops, stay inside until it's safe to exit, and only evacuate if it's unsafe to remain in the building. And tsunami, being by the harbour, if it's a very strong earthquake, then we will exit the building. We'll have to go down the stairs, and we will hot-foot it up Molesworth Street to the Parliament forecourt, or actually I would preferably go higher. So those are our emergency instructions. If you need the toilets, they're on either side here just a bit. If you walk straight ahead, you'll see them on your right on that side and on your left on that side. So that's all our procedures. The process this morning is Carolyn will come and say a wee bit about Andreas. He will then speak for approximately half an hour. Yep. We will then go into a Q&A session that Carolyn will manage the field the questions to pass to Andreas, and we will aim to wind up by 9 a.m. The presentation is being recorded, but when we get to the Q&A session, we will stop the recording. So you'll, or Calvin's here to do that for us. So that you feel free to ask any question you like, and Andreas feels free to give any answer he likes in the Q&A session.
Or no answer at all.
So I'll call on Carolyn to do the introductions.
Thanks, Jane, and kia ora tātou. Lovely to have you with us on this slightly blustery Wellington morning. But it's a great privilege to have Andreas with us in New Zealand. And as you know, he's the chair of the International Accounting Standards Board. And, you know, for our students, none of whom, of course, have got up early enough this morning to come in, but for those of us who've been students, one might wonder how someone becomes the IASB chair. And Andreas shared with us yesterday that he had 5 interviews or 5 sets of presentations and interviews over a long period, over a year, in the middle of COVID, before he was selected. And I think he makes an ideal case study for a standard setter, because he also shared with us that he did a very general degree at university, and he wasn't as strong in accounting and finance as he thought he should be. And so he started to really concentrate on financial instruments, and that's what his thesis is on. So if we want to talk about derivatives this morning, that would be an area. But through the course of his career has been a partner in Deloitte in Germany, sat on the German standard setter and chaired that from 2015 to 2021. And that, of course, gave him a seat at the European Financial Reporting Advisory Group, EFRAG, which takes on the IASB standards, and has been active in standard setting through an interest in international accounting standards. So he's really seen Germany's reactions, European reactions, and now he gets to travel the world and manage all of those voices from emerging economies, from very large economies. Lots of people saying, please, I want this change in the standard, or don't do that. And he is very well placed to share with us this morning the future of financial reporting. So I'll leave it to you, Andreas, and thank you again for coming to New Zealand, a small country at the bottom of the world, but I know one you've been to before.
That's right. Thanks very much, Karen and Jane. Thank you very much for the warm welcome. Good morning to you in the room, and good morning to you at the webinar. I was almost tempted to say, is there a future for financial reporting, and make that the headline of my presentation, but I thought that might have been a bit contentious, especially as the chair of the IASB. So I say there is the future of financial reporting, but I give you a few flavors as to the challenges that we are facing at the moment. I was told not to leave this spot so that actually the camera, which is just over there, could actually concentrate on me. It looks a little bit that I'm hiding behind my cursor, so get your eggs and tomatoes ready, right? So the shield will come up eventually. In the Q&A session, I might just wander a little bit more around. Okay, without further ado, let me start. It's all good to think about the future of financial reporting, but I think we all have to just acknowledge that we are not operating in a vacuum. I sometimes akin the IASB with a supertanker, and if the captain on the bridge says, all machines stop, the thing would just go for 30 nautical miles straight, right? Before you could actually think about, okay, should we probably have taken a left turn or a right turn? The IASB is very similar in that regard. Not that we are lazy, not that we are slow, but good, decent standard setting actually takes some time. And many practitioners are just scared if I tell them a decent standard probably takes 8 to 10 years to develop. And then their jaws drop and say, you must be joking. I mean, budgeting for next year is 1 year cycle. Midterm planning is 3 to 5 years, and everything thereafter is science fiction. So 8 to 10 years from now, I will be a happy pensioner. So, okay, what are my successes with that? So why is it taking so long? I'm not going to talk to that. Happy to reserve that for the Q&A if you want. But I thought I'd give you a little bit of a flavor of what we are doing generally. So we're best known as the international standard setter, which is obviously true, but we do far more than just setting and developing standards or amending existing standards. That occupies us approximately to 50% of our time. A good 20% of our time goes into what you see in the centers of the circle, stakeholder engagement. So trips like this, and it's not just the privilege of the chair that I can pick all the nice holiday destinations that I would have loved to go to, but all my 13 colleagues are doing the same thing, and our staff does as well. So we are taking stakeholder engagement very, very seriously, because if you have to look after 140 plus jurisdictions around the globe, you need to understand the environment that they operate in. You need to understand the challenges, and you can't just do that remotely from sitting in a cozy chair in London. You really have to make an effort and understand that and engage with various parties. So we take that quite seriously. Another 25% goes into what we call maintenance and consistent application. That's basically the work of the Interpretations Committee and limited amendments to our standards. And the remaining 5% about go into the bottom left quadrant, which is digital financial reporting. Now, you see digital financial reporting still listed in here as a separate domain. We rather think of it as being part of standards development, because we no longer differentiate whether you're developing a paper-based version or a digital version. We believe that the future has to go digital. And you can't think about digital implications once the standard is fit. So you really have to think about any digital implications as you develop the standard, because you have to be precise. If one thing doesn't exist in IT, it's fuzziness. Well, that's not entirely true. I work at the chair for statistics, and one of my colleagues over there actually was the co-inventor of fuzzy logic, and he would tell you, well, you can work about it, but you have to be precise. That's what I'm really saying. And you can't just put out fuzzy requirements. You have to be really concrete. And if you think about digital, that forces you to be precise. So we really merge the two. What you're seeing on the slide is some 20 projects that we are currently having on our agenda. They're all there for a purpose. And I tend to say that because the majority of our board members have started their work in the last 3 years. The majority of those standards, the standard development program, actually have existed for a far longer time. So we are now faced with something that our predecessors decided we should be focusing on. And several of my colleagues have scratched their hair and said, why on earth are we dealing with this? Who was the dull guy who actually put this onto the agenda? But there is a reason. Obviously, everything that we are doing is evidence-based. So if you see something in here, it has stimulated interest by some stakeholder in the past. So if we are thinking about the future, I think this is the one backstop. We do have a work program that we are working on, and the majority of our capacity is being occupied by that. So if you want us to focus on something extra, the shiny future, then you need to tell me what has to go, right? Because it's all good to put on new stuff and to prioritize other things, but you also have to tell me which things I should be deprioritizing. Just keep that in mind. So changing user demands and digital reporting's role in meeting these challenges. So this slide just gives you a flavor of the different environments that we are working with. It's all good to think about in an abstract way about what would the future ideal corporate reporting system look like. But we have to realize that the 140 plus jurisdictions that we are serving actually are quite diverse. They're culturally diverse. They're in different states of their economic development. We deal with emerging economies, with developing nations. We have the G7, G20, not all of them, but several of them, and they make themselves heard quite often. You do have different levels of experiences and different availability of resources in companies. So just give you one little touch point. One of our most recent standards was IFRS 17 that focuses on insurance contracts. If you think about a jurisdiction such as Sri Lanka, they do have 10 actuaries in the entire country. So how do you apply a new standard that is highly based on actuarial assumptions if you only have 10 actuaries in the country? And we may all smile about this and say, well, good thing, right? Yeah, but there's a valid concern by these jurisdictions. How do we cope with that? And if you think about, it's very easy for a jurisdiction to say, well, I'm not buying this standard. And that to me, obviously, is a worry as a standard setter, because the entire story about IFRS only works if everyone picks up the standards unchanged. And unchanged also means at the effective date that we set, right? But you can't just ignore these concerns that exist on the jurisdictional level. You have to take that seriously and find solutions. Well, then there are different objectives. I've been on a tour to Latin America, and I learned that many Latin countries are using IFRS across the board for everything, not just for consolidated financial statements, for which they were designed. They use that for statutory reporting, for tax accounting, for prudential oversight, and God knows what else. And then they're incurring several challenges. Well, that doesn't come as a surprise, because tax accounting has a quite different objective than financial reporting. Prudential oversight has a different objective than financial reporting. So if you see conflicting objectives, it doesn't come as a surprise that jurisdictions are crying for help and actually crying for resolutions. So what do we do with that? Do we just say, well, bad on you, you shouldn't have picked that for that purpose? Or do we try to do something about it? And different professional objectives. So you see the different stakeholder groups that we are having. And I realized that talking in a university, one actually I missed out, which is academics, but forgive me. So what's our framework in terms of digital? I said that digital is really the future. If you think about your day-to-day life, most things have gone digital, right? I still remember the times where I used this to take a call, right? Now I'm booking my holidays, cars, making restaurant reservation, and all of that. You can do everything digitally. You can listen to music through streaming. You can watch movies through streaming. You can read newspapers on your device. The one thing you can't do is do financial reporting in a digital way, because everything is digitized within the company. But the ultimate thing for it to actually prepare an annual report is to press one button, which is called print. That doesn't make an awful lot of sense. So if the economy is going digital, shouldn't financial reporting be part of that as well? And there's a strong selling case for that. If you go back in history, 25 years, when the IASB was erected, its key selling point was to equip multinational companies with what otherwise is known as a global passport. That means a uniform set of rules that you apply to your financial statements, and you could use those financial statements to list anywhere around the globe. That was the key selling mission. This mission has changed, because now it's no longer entities going abroad, it's investors coming in. So you don't have to go to NYSE or to the UK Stock Exchange. You can sit at home and wait for investors coming in. But they will only come in if they can access the data and the information in an easy way, and in a way that is commensurate to their understanding. And this is where digital then kicks in. Because if users can't access the information in a very quick and commensurate way, if they only have to deal with paper, or at best with a PDF version, they would just say, that's too hard. So either I make you pay a premium for that, or I would just bypass New Zealand and say, thank you very much, see you next time. And whether we like to hear that or not, that's just a reality. Digital reporting is a means, it's not the end, but is a means to actually funnel down investment decisions, to see the entire universe and do a quick scan about things that may be worthy of being investment. So we try to feed into that by producing what we call an IFRS taxonomy, which is basically nothing else than a dictionary of all our requirements to enable machine-readable financial reporting. That is what we are doing. So a taxonomy is nothing else than the machine-readable version of the same paper-based format that you know that the financial reports are. We develop those IFRS taxonomies. We do that in-house, and we, as I said, we do that concurrently with the development of the standards themselves. But we rely on other partners in the ecosystem. So we have strong ties to XBRL International. We obviously work a lot with the audit profession and with the regulators, because we can set the standards, but we can't enforce them. We can't mandate them on anyone. So we need others to help actually promulgate what we are doing and to actually ring fence the quality that is attached to that. Now, why is that important? Let me just skip that slide, because I think I have already alluded to that. Probably just one remark. If you see the term digital financial reporting, be mindful that different people have different understandings as to what this means, right? So I present you a very narrow version of that. Digital reporting means using our taxonomy and facilitating digital consumption of reports. You could obviously have a far more far-reaching an emerging view of digital reporting. If you think about AI, if you think about mass consumption, if you think about real-time consumption and preparation of data. So there are different facets about digital reporting. But if I say the IASB deals with financial reporting, digital financial reporting, we are keeping the narrow view for the moment at least, because you still want us to develop some standards. I think the bigger picture, I don't want you to read the slides, right? It's not meant to be an eye test. But it's there to actually pinpoint that digital reporting should also be thought of when it comes to sustainability reporting. For now 2 years, we do have a sister board that develops sustainability disclosure standards. And one difference between them and us in terms of how they go about standard setting is that they have decided to go digital from day one. Obviously, we have developed standards for the past 50 years, and the majority of that life actually was paper-based. So we had to take a conscious decision of moving over to digital. The ISSB said, in today's world, everything is digital, should be easy to access. So why should we actually develop the standards first in paper-based format and then think later about a digital version? So they have made the decision that they would go digital from day one. There's strong support internationally for their standards development. IOSCO, the International Organization of Securities Commissions, has recommended to member jurisdictions to pick up the ISSB standards, but not only those, but also the taxonomies. And this is very important because if you think about what I said before, investors want to have easy access to financial information. You could say exactly the same thing about sustainability information. And if you think about how sustainability reporting links up and connects into financial reporting, it wouldn't make sense to actually go digital only on sustainability reporting, but leaving aside the financial reporting. That's like a three-legged horse. Doesn't make very much sense. All right, so I've already used the buzzword connectivity, integration of financial reporting with non-financial reporting. So this is a slide that the ISSB and the IFRS Foundation has used over the past years to actually denote what our mandate is at the IFRS Foundation or at the IASB and ISSB respectively. The trustees have made a very conscious decision. They have said, we concentrate on users of financial statements or user of general financial purpose reports. And the users are those that are charged with making investment decisions. That's not to say you can disregard everybody else or just say, well, they don't really matter. But you have to concentrate on someone's needs if you want to set standards. If you just include everyone and embrace everyone in standard setting, you probably get nowhere. So this was a quite conscious decision, and it was an easy decision for the trustees because they said, why don't we pick the same user group for the ISSB that has served us well for the IASB? And if you believe and if you agree with me that the IASB's history is just but a success story, because we are the only private organization in the world that has really set international global standards, then why should the trustees depart from that role model? So it makes an awful lot of sense. So our work is denoted by that dark blue box, the traditional financial statements. What the ISSB, our sister board, is developing sustainability-related financial disclosures that are targeted towards investors. But if you do have a broader view, as here, for instance, in New Zealand, if you think about your climate disclosures, if you think about the impact on wider society, on nature and things like that, that's really for others to decide upon. Either jurisdictional frameworks, as here in New Zealand, or international frameworks, and you could think about GRI, for instance. So we don't make them superfluous, but we just take into account they have their remit, we have our remit. What we want to make sure is that actually the boxes connect to each other almost frictionless. They don't produce any gaps, and hopefully they don't produce any overlap either, or even conflicts. And then you see in the bottom right-hand corner, two funny things like integrated reporting and management commentary, that you could argue whether that is actually part of financial reporting or sustainability reporting. Is probably borderline there. So our mandate at the IASB only deals with the dark blue thing. Yes, we do have a project and a pronouncement on management commentary, but as you will know, our pronouncement only has the status of a practice statement and not of a standard. And that was decided on purpose 15 years ago, because in many jurisdictions, this is securities regulator space, and we can't really compete with them. Well, that still holds true. Happy to take a question later on. So what are the roles of the boards? I think I can go very quickly about this. You probably know this already. So the IASB develops the accounting standards. The ISSB develops the sustainability disclosure standards. We basically focus on financial position and performance and deal with everything that has happened up until the reporting date. What will happen tomorrow or after the reporting date is for next year's financial statements, but not for this year's financial statements. This is where the ISSB actually has a very important role, because it takes on from where we leave. Obviously, there are sustainability disclosures that apply to this year's period and probably also to the past. But more importantly, there are the entire information that deal with the future, short, medium, and long-term outlook. So users have long said it's all good that I'm being told what has happened this year, but I'm really interested as to where the entity is going, what its strategy is, what are the risks and opportunities. And we say, you won't find that in the financial statements. Go look somewhere else. You may find them in management commentary. You may find them in a sustainability report. Some you may find in a governance report. But be reminded that is not the role of the financial statements. So the purpose is really for our two boards to develop a cohesive, consistent set of requirements that would give the user of the financial statements a holistic view of a company. Not just the past and the present, but also a future, dealing with the strategy, risks, and opportunities. What we have to make sure is actually that our statements talk to each other, which we call connectivity or connectedness. So the ultimate game is that the ISSB and the IASB produce pronouncements that talk to each other and enable companies to produce information that talks to each other. So our ultimate game is really for companies to be able to tell a holistic picture that is internally consistent, that's using the same assumptions and the same understandings and concepts. The ISSB has made conscious decisions in actually pulling some key concepts and principles from our standards into their world. If you think about materiality, if you think about the role of these disclosures, the ring fence, the reporting period, they all take that from our literature, unchanged, because they believe that this would be the best way to actually facilitate the connectivity. So internally, we are aiming at having connected products, and we ensure that by having connected processes, which is the thing that you don't see because it's happening under the hood. This is just day-to-day business. So we talk to our colleagues at the ISSB on a daily basis. I have regular catch-ups with the leaderships of the other side. Our staff talks on a daily basis. The project teams talk on a daily basis. They inform each other about touch points of their work where it may impact the other board, to just highlight and say, okay, be reminded, this is tangential, and we want to make sure that actually we are not producing any conflicts here. And it could go both ways. So if they are going into our territory, we may reconsider some of our pronouncements. If we go into their territory, they might do the same thing. A perfect example of that is the much beloved climate-related and other uncertainties in the financial statements project, otherwise or previously known as climate-related risks in the financial statements. This was a project that was highlighted to us in the agenda consultation that the IASB has to do every 5 years to just tap the market and see what stakeholders really are interested in. Now, that agenda consultation drew to a close before the ISSB was erected. And that's important to keep in mind. I think many people just anticipated this is the most likely course because obviously the trustee consultation had already taken place. There was great support for that and everybody was working towards that. But at the time that the agenda consultation closed, there was no ISSB. So when we then reviewed the feedback, we thought, reading the comment letters, there were suggestions that didn't stop at climate risks in the financial statements, but many stakeholders said, could you please develop a standard on climate risk reporting? And we said, that's probably better dealt with by the ISSB, because that's really their territory, which they have concentrated on with S2. But does that mean we can just say, job done, thank you very much, nothing more for us? We believe, to my previous point about connectivity, we need to make sure that the climate-related disclosures they are proposing in S2 are actually linking up with the information that's being housed in the financial statements. So we really take a narrow focus on this project and say, our project is not about climate risk reporting, it's about climate risk reporting in the financial statements. And it doesn't mean that we just copy and paste everything that the ISSB has produced on their side, because, just to remind you, there is a role for the financial statements and there's a role for something outside of the financial statements. And we don't believe that by just merely copying everything else that exists outside of the financial statements has any benefit to the users of the financial statements. So, to make it abundantly clear, in this project we won't be developing a climate-related standard, but we will take stock of what the ISSB has written in S2 and think about the relationships and the touch points to various areas in our literature. Now, if I say that there is no standard on climate-related risks, and there will not be a standard on climate-related risks in the financial statements, what am I then referring to as touch points? Now, I hope that you're all strong believers in principle-based accounting standard setting. And there is one overarching standard, IAS 1, the oldest that we have. Well, it's about to retire, but anyway. IAS 1 contains the overarching concept that we use in financial reporting. The materiality principle, areas of significant judgment and uncertainty. I keep referring to IAS 1 as the least understood standard, because most companies that I'm aware of are looking at that standard when they transition to IFRS and then they shelve it and never look at it again. It's really a pity, because I think it's a pretty good standard. But if you think about the materiality principle, how do you apply materiality to climate-related risks? My instant answer would be not any different to how you assess financial risks or operational risk or credit risk. A risk is a risk is a risk is a risk. The ISB is risk agnostic. We don't really care what the risk is. We just say, if a risk has the potential of materially affecting your financial status, you must consider it. You can't ignore it. That's what our literature says. Where we are silent is how you do that. But we don't tell you how you have to do it in operational risk either. So what makes climate risk special? Why do you want us to do something especially exclusively for just one risk? And I'm pretty sure as soon as we've dealt with climate risk, you would knock on my door and say, oh, how about biodiversity? And how about human rights and labor relations? Beauty of principles-based standard setting. Don't blame me if you think our literature has become too complex. Then don't ask me for setting up new rules, right? Use your brain and don't surrender it at the reception desk. So where are we going next? This is what I said at the outset. We do have a loaded program. So if you want me to focus on something else, tell me which of these things go out of the window, right? So as part of the agenda consultation, we received suggestions for 70 new projects. 70. I told you we have 20 projects, and I give you one further data point. We have about 30 technical staff that are dealing with standard setting. 30 staff for 20 projects, all right? So no way that we could take on another 70. Forget about that. So we had to funnel that down. We first created a short list of 7, and we felt quite proud. But then we actually realized 7 is still quite a lot. That will be an additional 25% to our existing agenda. So can we do it to actually streamline it? Streamline to also send a very clear signal to the outside market and to stakeholders. Because if we are clear that we will not pick up a particular project, then you do not need to worry about it. You will not be bothered with a discussion paper or an exposure draft that we ask for your comments. You can just relax and concentrate on those issues that we are really dealing with. So we made a conscious decision to only deal with 3 topics. Intangible assets, because arguably there's a huge gap in our literature. Yes, we do have a standard on intangibles, but it's 25 years old. It was developed in a completely different environment and with a different purpose in mind. So the old standards have never gone through what we nowadays call a post-implementation review. So we believe it's high time to actually revisit this and look into, is the standard still working, or are there roadblocks that we should devote our attention to and possibly make some adjustments. Secondly, statement of cash flows. Now, most people in this room will probably say, what's wrong with the statement of cash flows? Pretty old standard, IAS 7, but by and large is working probably okay. Now, if you ask the users, they say, this is one of the most flawed statements that we could think of. That's interesting. Why? Well, because it doesn't denote non-cash items. Hang on, give me a pause. This is called the statement of cash flows. It's not called the statement of non-cash flows, right? Why would you expect non-cash items to appear in the statement of cash flows? And then they say, well, I get that. So we are not so much looking at the statement per se. It's about changes that happen in the working capital that you can't depict from the statement of cash flows. And that's creating a big worry because cash is shifted from one jurisdiction, from one entity to the other, and users can't see that. So this is just one example. Another example, obviously, is the touch points with the income statement that we are about to change. IFRS 18 is coming out in 3 months. And if we are actually changing the structure of the income statement, many people have asked us to do a recap as to how that relates to the cash flow statement. So that's something that we will be starting. Both projects will be started in the first half of next year. The one project that we have started already is climate-related risk in the financial statements, as I said, but take into account what's the headline above it. It says maintenance and consistent application. It doesn't say research pipeline projects. And you should keep that in mind. This is a narrow scope project that has a defined target. It's not there to produce or develop a climate risk standard. And then we do have a so-called reserve list. If we find ourselves in the happy situation that we are much faster and more efficient in standard setting and actually have spare resources before the agenda cycle draws to a close, then we would draw our attention to one of these remaining 2 operating segments and pollutant pricing mechanisms. So what are we going to do with intangibles? And I'm not going to run through all the projects. I'm just closing in on intangibles, and this will be my last slide, and then I'm happy to take any questions that you may have. So for intangible items, we have heard quite a bit. And I think the general concern is that IAS 38 is still based on a company that is a manufacturing company with R&D activities. But if you look out and look into the economy, you would find that the majority of the GDP is actually earned in the tertiary sector, which is service-oriented companies. And obviously, intangibles mean quite a different thing for a service-oriented entity. Yes, of course, know-how, patents, customer relationships exist in manufacturing companies as well. But for service-oriented companies, you can't see anything of that value creation potential that otherwise would be sitting on the left-hand side of the balance sheet. Well, if you can't see the potential, you can't see the depletion and consumption of that potential either. So it's not only that the balance sheet is probably utterly wrong, it's also that the income statement is utterly wrong. The periodization of the expenses is wrong because you really expense everything as incurred, which doesn't tell you anything. And then you could say, well, entities are free to give further information in the notes. How many companies do you know that do that? Thank you very much, right? So obviously, there is a need to increase transparency in this very important sector. I should stress that the objective is not to bring any thinkable intangible onto the balance sheet. Because if I said that, that would frighten the horses, probably, of the entire world economy. People are saying, are you crazy? This is not your job. This is the job of analysts and investors. Your job is to give the information and they make the adjustments. But we will see where we are going. So one of the first things that we have to define is the problem. What is the problem that we are trying to fix? And what ways are there to fix that? The one thing that I hope to be promising to you is that this will not become a strong contender to IFRS 17, which took some 20 years to develop. We try to be a bit faster than that, meaning that we try to do it in chunks. But you have to be very, very mindful if you do that, because you don't want to set certain requirements in an early stage that you then have to revoke or change in a later stage again. So you need to be reasonably assured that what you develop in the first stages actually stays on in the subsequent periods. All right. So my concluding slide. I was asked how I would change the way the IASB operates when I was 2 weeks in my tenure. And I used that slide. And I think when I revisited that, I could still actually subscribe to all the statements that I made on that slide. We are living in a fast changing environment. We want to stay relevant. I think financial reporting is relevant. So clearly the answer to the question, is there a future? Yes, there is a future. The fact that you don't see us appear on the headlines anymore, and you only see climate risk sustainability all over, I actually take with great pride, because I have lived in this space when actually financial reporting was on the front page. And that was pretty ugly, I can tell you. That was at the times when we had the financial crisis and everybody wanted us to change our requirements rapidly, right? So sailing under the radar is not a bad thing. And especially if users are telling you, actually don't tinker with financial reporting. The system is working. It may not be picture perfect, but it achieves what it was meant to achieve. If you have further information, happy to take it, but don't tinker with the system. So it is working. Keep that in mind. But there are challenges. So one program that I installed when I assumed office was the Scanning the Horizon program, which is something that you have never heard anywhere. There's not an official project in that time. That's an internal domain. We have a dedicated team that continuously surveys the environment for macroeconomic and macropolitical changes that may have an impact on financial reporting. Why? If there is one thing that I would say about the deficiency in financial standard setting, reporting standard setting, it is that we have a tendency to deal with yesterday's problems, not with today's problems. And if you then take what I said at the start, that a good standard takes about 8 to 10 years to develop, you come 8 to 10 years with a result after the fact. So if you want to counter that, you actually need to become better in forecasting. So you need to peek ahead to actually assume some of the things that you're seeing on the horizon, do some upfront research to give you a head start to actually set and go, to shorten that period down to a reasonable time so that actually your solution that you produce arrives when the issue is still acute and hasn't gone away. With that, I shall close. Thank you very much for your attention, and I'm open for any questions that you may have. Thank you.